For federal tax, the default rule is simple. If you have an unincorporated business with 2 or more owners, it's generally treated as a partnership. That means the partnership itself usually doesn't pay income tax. Instead, it calculates income and deductions, then passes the results through to the partners. On the EA exam, they love the phrase pass-through entity. Here's the key pass-through idea. Income or loss is determined at the partnership level, then each partner reports their share on their own return. It feels like a sole proprietorship in that the tax lands on the owners, not the entity. The big difference is you have multiple owners, so allocations matter. If you see partnership computes, partners pay, you're on track. A partnership must always have at least 2 partners, and at least one has to be a general partner. Think of the general partner as the person who can bind the business and is on the hook for debts. Limited partners may have liability protection, but you can't have a partnership made up of only limited partners. On exam questions, watch for that minimum structure. Formation is another exam favorite. A general partnership can exist with almost no paperwork, sometimes just 2 people acting like co-owners in a business. But if the arrangement includes liability protection for some partners, like a limited partnership or LLP, you usually need formal documents and state filings. So, no formalities required for general partnerships, but limited liability flavors typically require them. Not every 2-person arrangement is a partnership. A joint undertaking just to share expenses is not a partnership. And simple co-ownership of property by itself usually isn't a partnership either. A classic example is 2 people owning a rental property together. If they're merely collecting rent and splitting costs, that's typically co-ownership, not a partnership business. The exam tests this distinction a lot. Finally, some entities are barred from partnership classification. A corporation can't be taxed as a partnership, even though it can be a partner in one. Also excluded are things like insurance companies, certain banks, government entities, tax-exempt organizations, REITs, and trusts or estates. And any eligible entity that elects corporate status, like filing Form 8832, won't be treated as a partnership. With regards to the Centralized Partnership Audit Regime, or CPAR, which statement is true? Is electing out automatic under 100 partners? Are only partnerships over 100 partners subject to CPAR? Or, unless the partnership makes a valid opt-out election, CPAR procedures apply? Think about what the default rule is. The correct answer is, unless the partnership makes a valid opt-out election, the CPAR audit procedures will apply. That's the default. A tempting wrong choice is the idea that being under 100 partners automatically avoids CPAR. It doesn't. The partnership has to qualify and then actually make the election to opt out. Unlike limited partners, general partners have what for a partnership's debt obligations? Is it non-recourse liability, joint and several liability, legal absolution, or limited responsibility? Focus on who is personally on the hook when the partnership can't pay. The correct answer is joint and several liability. General partners are personally liable for partnership debts and obligations, typically on a joint and several basis. A tempting wrong answer is limited responsibility, because that sounds like limited partners. But general partners don't get that protection just from being a partner.